There is a quiet mechanism in the money system that most homeowners do not understand. It does not look like a bailout. It does not arrive as a check in the mail. It does not show up as a line item on your mortgage statement saying your debt has been reduced. It happens through the value of the dollar, and once you understand it, a fixed rate mortgage begins to look very different from the way most people were taught to see it. Most people think debt is always bad. They were told that the responsible thing is to pay it off as fast as possible, sleep better, and live with no obligations. That advice can be right in some environments and wrong in others. Like most simple rules, it becomes dangerous when people apply it without understanding the larger system. Debt is not one thing. A credit card at 25% is not the same as a 30-year fixed rate mortgage at 3%. A variable rate loan is not the same as a fixed rate loan. Debt used to buy consumption is not the same as debt attached to a real asset. Debt in a currency being debased is not the same as debt in a hard money system. The same word can describe very different realities. That is why principles matter more than slogans. If you have a low fixed rate mortgage, and the country enters a period where inflation is allowed to run above the interest rate on that mortgage, something important happens. Your monthly payment stays the same in nominal dollars, but the purchasing power of those dollars declines. You borrowed stronger dollars and you repay with weaker dollars. That is the core mechanism. It is the same mechanism governments use when debt becomes too large to solve honestly through taxation, spending cuts, or growth alone. They do not always default. They do not always cancel the debt openly. They allow inflation to reduce the real weight of the debt over time. That is financial repression. Now, I want to be careful. The viral story around a new Fed chair and a precise date or plan may be overstated. One individual does not become a king of the monetary system. The Federal Reserve is a committee. Policy depends on inflation, markets, politics, the Treasury, banks, the labor market, and the economy. Specific dates and exact targets should be treated with caution, but the deeper mechanism does not depend on one person. The United States has a very large debt burden. The interest cost of that debt has become a major pressure on the federal budget. A large share of government debt must be refinanced repeatedly. When rates stay high, the cost rises. When inflation is tolerated and rates are held below inflation, the real burden of debt falls. That is the structural incentive. It is bigger than one chair. It is bigger than one administration. It is bigger than one news cycle. When debt is too large, the system often chooses the quiet path. The quiet path is to reduce the value of the money in which the debt is measured. That is how a government can reduce its debt burden without formally defaulting. And if you own a long-term fixed-rate mortgage, the same mechanism can reduce the real weight of your mortgage. You are not the target of the policy. The government is trying to manage its own debt. But your fixed debt is written in the same dollars, so you can become a side beneficiary of the same process. That is the part most people miss. The government borrows in dollars. You borrowed in dollars. If the dollars become less valuable over time, the real cost of repaying those debts goes down. The creditor receives the nominal dollars promised, but those dollars buy less than they did when the loan was made. This is why fixed-rate debt can become valuable in an inflationary environment. Not all debt, fixed-rate debt, long-term debt. Debt tied to an asset whose value and income potential may rise with inflation. That is very different from high-interest consumer debt. A credit card adjusts quickly, a floating-rate loan adjusts, a short-term loan must be refinanced. But a 30-year fixed mortgage locks in the cost of the debt while the world around it changes. That lock can be a gift. Most people do not see it because they measure the mortgage in dollars instead of purchasing power. If your mortgage payment is $1,800 today and remains $1,800 10 years from now, the number is the same, but the burden may be very different. If your income rises, if rents rise, if prices rise, and if the value of money falls, that same $1,800 may feel much lighter. The payment did not change, the world changed around the payment. That is the key. Inflation hurts people when their income and assets do not adjust. It helps debtors when the debt is fixed and the money used to repay it loses value. The same inflation that punishes savers can benefit fixed-rate borrowers. This is not moral. It is mechanical. The system does not care whether you are a good person, whether you follow the traditional rules, whether you were disciplined, or whether you feel the arrangement is fair. It simply rewards and punishes positions based on how they interact with the environment. A saver earning less than inflation is on the losing side. A fixed-rate borrower owning a real asset can be on the winning side. That is the framework. Now think about the national debt. The government owes a very large amount of money. It must roll over debt continually. If rates are high, interest expense grows. If interest expense grows too much, it crowds out other spending and creates political pressure. The government has several theoretical options. It can raise taxes, it can cut spending, it can grow rapidly enough to reduce debt relative to GDP, it can default, or it can reduce the real value of the debt through inflation and low real interest rates. Raising taxes at the scale required is politically difficult and economically risky. Cutting spending at the scale required is politically painful because the largest parts of the budget are difficult to touch. Growing out of the debt is ideal, but it requires sustained productivity and real growth that cannot be ordered into existence. Default would damage the global financial system because U.S. government debt is the foundation of collateral, banking, reserves, and institutional portfolios around the world. So the quiet path becomes attractive. Financial repression. That means rates are held lower than inflation for a period of time, whether by explicit policy, regulatory pressure, central bank action, or the broader structure of the system. Savers receive returns that do not keep up. Bondholders are repaid in weaker dollars. The debt burden shrinks in real terms. This has happened before. After World War II, the United States had a very high debt to GDP ratio. Over the following decades, the debt burden fell dramatically. It was not simply paid off with discipline. It was reduced through growth, inflation, low controlled interest rates, regulation, and the erosion of the real value of debt. The bondholders got their dollars. The dollars were weaker. That is how debt can be repaid and diluted at the same time. Most people do not understand that distinction. They think a debt is either paid or defaulted. There is a third path. It is paid in money that has been made less valuable. That is the path that matters today. Now let us translate this to your mortgage. Suppose you have a 30-year fixed mortgage at a low rate. The payment is fixed, the rate is fixed, the balance amortizes according to schedule. The bank cannot suddenly raise the rate because inflation rose. That is the power of the contract. If inflation rises, the nominal cost of many things rises. Wages may rise, though often unevenly and with delay. Business revenues may rise if the business can raise prices. Rents may rise in many markets. The nominal value of real assets may rise, but your mortgage payment remains the same. That creates a widening gap in your favor. Your income side may adjust upward over time, your debt payment does not. If you own a rental property with a fixed rate mortgage, the mechanism can be even clearer. Rent may increase over time with inflation and market conditions, the mortgage payment remains fixed. If expenses are controlled and the property is managed well, the spread between rental income and mortgage cost can improve. Again, this is not guaranteed. Property taxes, insurance, maintenance, vacancies, and local market conditions all matter. But the debt structure itself can be powerful. Fixed rate debt attached to a productive or useful real asset can become easier to carry in inflationary environments. This is why the instruction to pay off every mortgage as fast as possible can be incomplete. Paying off a mortgage is not always wrong. It can reduce risk, it can create emotional peace, it can make sense if the rate is high, if income is unstable, if the person is near retirement and values simplicity, or if the alternative use of cash is weak. Financial decisions are personal. But if the mortgage rate is very low and inflation is higher, every extra dollar sent to the mortgage may be a dollar used to retire cheap debt that the monetary system may be eroding for you. That may not be the best use of capital. This is where people must think in real terms. If your mortgage rate is 3% and inflation is 4%, your real interest rate is roughly negative. You are effectively paying back the lender with money losing value faster than the interest cost. In that situation, accelerating the mortgage may feel responsible but may not be mathematically optimal. The emotional satisfaction of being debt-free must be weighed against the opportunity cost of giving up liquidity and paying down low-cost fixed debt. Opportunity cost matters. If you send $20,000 to reduce a 3% mortgage, you save 3% interest before considering tax effects and other factors. If that same $20,000 could earn more after tax in a diversified portfolio, treasury bills, productive assets, real estate improvements, business investment, or emergency liquidity, then the decision is not obvious. This is why financial advice must adapt to the environment. In a high-rate, low inflation world, paying down debt may be attractive. In a low fixed rate, higher inflation world, keeping the debt may be advantageous. The principle is not always pay debt. The principle is understand the real cost of debt and the alternative uses of capital. Now let us talk about the losing side of financial repression, because for every real debt burden that shrinks, someone else receives the weaker dollars. Savers are often the losing side. People holding cash in bank accounts earning very little are especially vulnerable. If inflation is running above the savings rate, the purchasing power of that cash is being drained. The nominal account balance may stay the same, but the real value is falling. This is why a savings account can be dangerous when misunderstood. It is useful for liquidity, it is useful for emergency reserves, it is useful for near-term spending, but as a long-term store of wealth in a financial repression environment, it can be a slow transfer of purchasing power away from you. A person earning almost nothing on savings while inflation runs several percent is funding the system through lost purchasing power. No tax bill arrives, no statement says, you lost real wealth, but the loss occurs. This is why checking your savings rate against inflation is important. Not because everyone should move every dollar out of the bank, that would be reckless, but because cash has to be placed deliberately. Cash for near-term needs is prudent. Excess cash held for years below inflation is costly. The same logic applies to long-duration bonds. If you lock in a low interest rate for a long time and inflation runs hotter than expected, you can be repaid in money that buys less in nominal terms. The bond pays as promised in real terms. The bondholder loses purchasing power. This is how the system transfers wealth from lenders to borrowers. Again, this is not about morality, it is about position. Are you mainly a lender receiving fixed payments or a borrower with fixed payments? Are you holding cash or owning assets that can reprice? Are you saving in dollars or owning things that can preserve purchasing power when dollars weaken? This is the question. Now consider the advice many people were given. Pay off your mortgage early. Keep a large cash reserve in a major bank. Avoid debt. Buy CDs, own bonds. Feel safe. Those rules may have made sense in certain periods, but if the policy environment shifts toward repressing savers and debt holders, the same rules can create different outcomes. This is one of the hardest things for ordinary people to accept. A rule that was wise in one regime can become costly in another. Good principles remain, but tactics must change. The principle is to preserve purchasing power and reduce fragility. Sometimes that means paying down debt. Sometimes that means keeping cheap fixed rate debt and investing elsewhere. Sometimes that means holding more cash. Sometimes that means reducing cash. Sometimes that means owning bonds. Sometimes that means avoiding long duration bonds. The environment matters. This is why mechanical advice can be dangerous. Now, the original argument uses a battery analogy. I think it is useful. A dollar is like a battery. The number printed on it is the casing. The purchasing power is the charge. Inflation drains the charge. The casing still says $1, $10, $100. But the charge inside is lower. Debt is written in those same batteries. If you borrowed when the batteries had more charge and repay later, with batteries that have less charge, the real burden of the debt is lower. That is exactly what happens when fixed-rate debt meets inflation. The lender receives the casing. The borrower benefits from the drain charge. This is simple, but most people do not think this way. They think in nominal numbers because that is how statements are written. Mortgage balances, bank accounts, wages and prices are all shown in dollars. But wealth lives in what those dollars can do. The person who understands the battery understands the game. The person who does not understand it may celebrate a stable bank balance while real wealth leaks away. Now let us examine the 3 practical moves in the source argument, but in a more principled way. The first move is to understand your mortgage, pull your amortization schedule, understand your rate, understand your remaining term, understand how much of each payment goes to interest and principal over time, understand whether the rate is fixed or variable, understand whether there are prepayment penalties, understand what the payment looks like in year 10 and year 20. Most people own the largest debt of their lives and have not studied the schedule. That is not acceptable. You need to know whether your mortgage is a burden or an asset in disguise. If your mortgage rate is below current inflation and below what you can reasonably earn on low-risk or productive alternatives, accelerating payoff may not be optimal if your mortgage rate is high, variable, or creating stress. The analysis changes. If you are close to retirement and the mortgage creates psychological pressure, the analysis changes. If your income is unstable, the analysis changes. But if you have a low-rate fixed mortgage, you should at least understand the value of that loan before rushing to destroy it with extra payments. In an inflationary debt dilution environment, a low fixed-rate mortgage can be a powerful financial position. You locked in the cost of capital before the cost of capital rose. That has value. Do not give it back casually. The second move is to compare your savings rate with inflation. Do not ask only what the bank pays, ask what the money keeps. If inflation is higher than your interest rate, your real return is negative. If you are earning 0.01% while inflation is several percent, you are losing purchasing power at a meaningful pace. This does not mean you should chase unsafe yields. High yield can hide risk, but it does mean you should not leave large idle cash balances in accounts that pay almost nothing simply because you have not paid attention. There are often alternatives for cash reserves: high-yield savings accounts, treasury bills, treasury money market funds, short-term government funds, and other structures depending on the person's needs and risk tolerance. Each has trade-offs. Bank accounts have FDIC limits and convenience. Treasury bills have government credit exposure and different liquidity mechanics. Money market funds are securities, not bank deposits. Online banks may pay more but should be evaluated for insurance, access, and reliability. The point is not to maximize yield blindly. The point is to stop allowing inertia to drain purchasing power. Inertia is expensive. The third move is to think carefully about home equity. Home equity is stored wealth inside a real asset. Many people feel proud when they have a lot of equity, and they should. But equity can also be illiquid. If all your wealth is trapped in the house and you have little cash or investment liquidity, you may be house rich and cash poor. Accessing equity can be useful in some situations, but it must be done carefully. A HELOC, cash out refinance, or reverse mortgage can all change risk. A HELOC may have variable rates. A cash-out refinance may destroy a low fixed rate if done poorly. A reverse mortgage can be useful for some retirees, but has complex terms and costs. Borrowing against a home to spend on consumption can be dangerous. The principle is not borrow more. The principle is understand where your wealth is stored and whether it can be deployed without increasing fragility. If you have a low fixed-rate mortgage, replacing it with a high-rate loan just to access cash may be a mistake. If you can access equity through a structure that does not destroy the valuable fixed-rate mortgage, that may be different. If you use home equity to buy cash-flowing assets, improve financial resilience, or create productive capital, the analysis is different from using it to fund lifestyle. Debt against a home can help or hurt depending on use, rate structure, and discipline. Again, principles over slogans. Now I want to address the emotional resistance to not paying off a mortgage. For many people, debt feels like a moral burden. They were raised to believe owing money is always bad. They want the peace of owning the home free and clear. That peace has value. Money is not only math, but peace purchased at too high a cost can reduce resilience. If you use all available liquidity to pay off a low-rate mortgage, you may feel safe but become less flexible. You may have no cash for emergencies. You may miss opportunities. You may have more net worth in the house but less ability to respond to life. You may have reduced a low-cost obligation while increasing dependence on one illiquid asset. That is not always safety sometimes. It is a different form of concentration. A fully paid-off home can be wonderful, but it does not pay groceries unless you borrow against it or sell it. Liquidity matters, so the decision should not be emotional alone. It should include math, risk, liquidity, taxes, age, income, and the inflation environment. A person with a 7% mortgage may rationally prioritize payoff. A person with a 3% fixed mortgage may rationally preserve it. A person with no emergency fund should not send every extra dollar to the lender. A person with unstable income may value debt reduction differently. A person near retirement may choose peace over optimization. There is no universal answer. But there is a universal requirement: understand the real trade-off. Now let us talk about the Fed's role in this story. The Federal Reserve does not directly cancel your mortgage. It does not call your bank and reduce your balance. It does not create a personal bailout for homeowners. That is not how the mechanism works. The Fed affects the environment. It influences rates, liquidity, inflation expectations, and the broader cost of money. If policy results in inflation running above the fixed rate of your mortgage, then the real burden of your mortgage declines. That is indirect, but indirect mechanisms can be powerful. The same is true for government debt. The government does not need to erase the nominal number if it can reduce the real value of the number through inflation. It can pay every dollar and still reduce the true burden. That is why people misunderstand debt cancellation. They expect a visible act, but the more common act is invisible dilution. The government debt is diluted. Your fixed mortgage is diluted. Your savings are diluted too. The mechanism helps borrowers and hurts savers. This is why you must understand which side of the ledger you are on. If you are a saver holding cash below inflation, you are lending purchasing power to the system at a loss. If you are a fixed-rate borrower, the system may be reducing the real value of your obligation. If you are an asset owner, inflation may raise the nominal value of your assets. If you are only a wage earner with no assets, you may suffer because expenses rise faster than wages. If you own a business with pricing power, you may pass through inflation. If you own a rental property, rents may rise, though costs can rise too. This is the structure. Now let us examine the idea that income rises with inflation. It often does, but not equally. Business owners with pricing power can raise prices. Landlords may raise rents where market conditions allow. Workers may receive cost of living increases, but often with delays and not always enough to keep up. Retirees on fixed income may be more vulnerable unless benefits adjust. Savers in low-yield accounts may lose, so when someone says inflation helps debtors, that is generally true for fixed-rate debtors, but only if their income or asset values adjust enough to continue servicing the debt. This is important. Inflation can reduce the real value of debt, but it can still create cash flow stress if food, energy, insurance, and taxes rise faster than income. A mortgage may become lighter in real terms while the household budget becomes tighter in the short term. That is why you need liquidity. You cannot rely only on long-term mathematical benefit if short-term cash flow breaks you. The homeowner with a low fixed mortgage should still maintain emergency reserves, avoid excessive consumption debt, and invest intelligently. A favorable mortgage does not make the whole financial life safe. It is one useful position. Now let us talk about hard assets. In a debt dilution environment, hard assets can be important because they are not easily printed. Real estate, gold, productive land, certain infrastructure, commodities, and scarce assets may rise in nominal terms as the currency weakens. The same is true of high-quality businesses that own productive assets or have pricing power. But hard assets are not magic. Real estate can be overvalued, gold can be volatile, commodities can crash, a property can have bad tenants, insurance can rise, taxes can rise, local regulation can change. So the point is not to buy anything physical at any price. The point is to prefer assets whose value is linked to real economic utility or scarcity over excessive claims on fixed dollars. That distinction matters. A low-yield savings account is a claim on dollars. A 30-year fixed mortgage is an obligation in dollars. A house is a real asset. A business with pricing power produces goods or services people need. In inflation, these categories behave differently. Now let us consider a homeowner with cash in the bank and a low fixed mortgage. Many people in this situation face a decision. Should they use the cash to pay down the mortgage? Should they invest it? Should they hold it? Should they buy another property? Should they buy treasuries? Should they improve the home? Should they build a business? There is no single answer, but there is a process. First, keep enough liquidity for emergencies. Second, eliminate high-interest debt. Third, understand the mortgage rate relative to inflation and alternative returns. Fourth, consider taxes and risk. Fifth, decide whether extra principal payments improve your resilience or simply reduce a cheap liability. Sixth, deploy excess capital into assets that can preserve purchasing power if appropriate. This process is better than blindly following a rule. The rule pay off all debt ignores cost of capital. The rule never pay off cheap debt ignores emotional risk, life stage, and cash flow needs. A principle-based approach looks at the whole system. That is the way to think. Now let us talk about the person holding cash in a major bank at almost no interest. This is one of the most common and costly mistakes. The person may believe they are conservative, they may have worked hard, saved diligently, avoided risk, and accumulated a meaningful balance. But if the bank pays almost nothing, while inflation reduces purchasing power, the person is losing quietly. The bank may use deposits to make loans or buy assets at higher yields. The depositor receives very little. That spread is part of the banking business. There is nothing inherently wrong with banks earning spreads. Banks perform functions, but the depositor must understand the trade. If you are leaving large money at low yield because you are uninformed or inert, you are giving away value. At minimum, compare rates, understand deposit insurance. Consider treasury bills or insured high-yield accounts, separate operating cash from long-term wealth. Make cash work as hard as possible within the risk level appropriate for its role. Cash should not be lazy unless laziness is the price you intentionally pay for immediate access. The word intentionally matters. Unintentional low yield is a leak. Now let us address the claim that bankers will not call you to explain the value of your low fixed mortgage. Of course, they usually will not. Their job is not to optimize your entire financial life. A lender benefits from lending, a bank benefits from deposits. A financial institution is not automatically your teacher. It may provide services, but its incentives are not identical to yours. This does not mean the bank is evil. It means you are responsible for understanding your own position. The system is full of incentives. Banks want deposits, lenders want loans, advisors may want assets under management, brokers may want transactions, governments want manageable debt, central banks want policy flexibility. You must understand incentives or you will be shaped by them. The person who does not understand incentives becomes the raw material of someone else's business model. That is harsh, but true. Now, how does this connect to a fixed rate mortgage? The bank made a loan to you at a certain rate. If rates later rise and inflation runs higher, that old loan may become less attractive to the bank and more attractive to you. The bank cannot easily change the contract. That is why the fixed rate structure has value. If you refinance unnecessarily, accelerate payoff without analysis, or trade the fixed debt for variable debt without understanding the risk, you may give away that value again. Do not be clever for the sake of being clever, but do not be naive either. The mortgage contract is an asset liability position. It has value or cost depending on the environment. Study it. Now let us talk about the two roads idea. One road is to keep doing what you were told without re-examining the environment. Accelerate the mortgage because debt is bad. Keep cash in a low-yield account because banks feel safe. Wait for the news to confirm the trend. Assume the old rules apply. That road may feel responsible. But if the environment is financial repression, it can lead to real loss. The other road is to understand the mechanism, recognize the debt cycle, recognize that inflation can reduce the real burden of fixed debt, recognize that savers earning below inflation are the funding source. Recognize that real assets and productive assets may preserve purchasing power. Recognize that cheap fixed-rate debt can be valuable. Then act with discipline. This does not mean reckless borrowing. It means intelligent positioning. There is a very large difference. A reckless person hears fixed debt gets inflated away and borrows too much. A disciplined person says, I will preserve valuable low-rate debt, maintain liquidity, avoid high-interest debt, own productive assets, and not give the system back the advantage I already have. The same insight can lead to very different behavior depending on character. That is why principles must come with discipline. Now let us talk about the danger of extracting home equity. Some people hear that a mortgage is beneficial and decide to borrow aggressively against the home. That can be dangerous. Home equity is not free money, it is debt. If the borrowed funds are used poorly, the homeowner can turn a strong position into a weak one. If you borrow against a home to buy depreciating assets, fund lifestyle, or speculate, you may increase fragility. If you borrow carefully at reasonable terms to invest in cash-flowing assets, build a business, or improve the property, the analysis may be different, but you must stress test. What if rates rise? What if income falls? What if the investment underperforms? What if property values decline? What if rents do not rise? What if liquidity disappears? Debt magnifies outcomes. It can help you if the structure is right. It can hurt you if the structure is wrong. The existence of inflation does not repeal the need for risk management. Now let us consider retirees. A retiree on fixed income holding large cash balances may be especially vulnerable in financial repression. Expenses rise, savings yields may lag. The retiree may not have wages that adjust. If the retiree also has a low fixed mortgage, the decision to pay it off should be examined carefully. Peace of mind matters, but liquidity and purchasing power matter too. If paying off the mortgage drains liquidity and leaves the retiree dependent on a smaller cash reserve, the risk may increase. If keeping the mortgage allows more money to remain invested or in higher yielding safe instruments, the retiree may be better positioned. But if the mortgage payment causes anxiety or cash flow pressure, paying down may still be sensible. This is why one-size advice fails. The right answer is personal but must be grounded in real rates, liquidity, inflation, and risk. Now let us consider younger homeowners. A younger homeowner with a low fixed mortgage may have decades for inflation to reduce the real payment. If income grows over time and the payment remains fixed, the mortgage can become easier to carry. Extra payments may not be the best use of capital, especially if the person has a long time horizon and can invest productively. But the same younger homeowner must avoid lifestyle inflation and bad debt. It would be foolish to keep a cheap mortgage while accumulating credit card debt, car loans, or speculative margin debt. Debt hierarchy matters. Pay off expensive, flexible, toxic debt. Respect cheap, fixed, productive debt. That is the principle. Now let us talk about purchasing power again because it is the central issue. If you only remember one thing, remember that wealth is not the number of dollars. Wealth is what the dollars can buy. A mortgage is not only the number owed, it is the real burden of the payment relative to your income, assets, and the purchasing power of money. If the dollar loses charge, both your savings and your debts are affected. The saver loses, the fixed rate debtor gains. The asset owner may gain, the cash holder may fall behind. The difference is position. That means the same inflation can be good or bad for you depending on your balance sheet. If you own no assets and have rising expenses, inflation hurts. If you own productive assets and fixed rate debt, inflation may help parts of your balance sheet. If you hold mostly cash, inflation hurts. If you hold long fixed rate debt as a borrower, inflation reduces the real obligation. This is why understanding your personal balance sheet is more important than repeating slogans about the economy. Macro becomes personal through your assets and liabilities. Now let us build a practical framework. The first question is, what debts do you have? List them by interest rate, term, fixed or variable, purpose, tax treatment, and collateral. The second question is, what assets do you have? Cash, savings, retirement accounts, stocks, bonds, real estate, business equity, precious metals, other assets. The third question is, what is your real exposure to inflation? Does your income rise with inflation? Do your assets reprice with inflation? Are your debts fixed? Are your expenses flexible? The fourth question is, where are you losing purchasing power? Low yield cash, long duration fixed income, unproductive assets, excessive idle balances. The fifth question is, where can you improve without increasing fragility? Higher yield insured cash, treasury bills, diversified equities, real assets, paying down high interest debt, maintaining low fixed debt, building liquidity, reducing variable rate exposure. This is how you make the idea practical. You do not need to guess the exact Fed path. You need to see how the path would affect your balance sheet. Now, I want to be very clear about the risk of overinterpreting the mortgage bailout idea. Inflation reducing the real weight of a mortgage does not mean the mortgage disappears. You still have to make payments. If you lose your income, the payment still matters. If insurance and property taxes rise, the home can become more expensive. If your wages do not keep up, inflation can still hurt you. If you use the mortgage savings as an excuse to overspend, you can still be worse off. The benefit is real, but it is not magical. It works best for people who maintain income, control expenses, and invest or preserve the capital they would otherwise have used for extra mortgage payments. If you do not accelerate the mortgage but spend the extra money on consumption, you may not be better off. You simply converted a potential advantage into lifestyle. The strategy only works if the capital is used intelligently. That means investing, building reserves, buying productive assets, or otherwise improving the balance sheet. Do not confuse not paying extra principal with having free money. The money must have a job. This is the difference between a strategy and an excuse. Now let us talk about the broader debt cycle. When an economy carries too much debt, policymakers often face a difficult set of trade-offs. They want to support growth. They want to control inflation. They want to maintain confidence in the currency. They want to keep the government financed. They want to avoid banking stress. They want to avoid unemployment. These objectives can conflict. If rates are too high, debt service becomes painful. If rates are too low, inflation can persist. If inflation is too high, savers and workers suffer. If inflation is too low and debt is high, the real debt burden remains heavy. Financial repression is a compromise. It allows debt to shrink in real terms while avoiding formal default. But it does so by taxing holders of money and fixed claims through negative real returns. This is why people must own assets, not only save currency in a debt-heavy world. Currency is often the release valve. If you hold only the release valve, you absorb the pressure. That is the core danger. Now let us talk about high-quality assets. If you decide not to pay extra toward a low-rate mortgage, where should capital go? It depends, but the general categories are the same. Productive businesses, real assets, hard assets, and liquidity tools that at least reduce the inflation drag. High-quality equities can help because businesses with pricing power can raise prices and grow earnings over time. Broad diversified funds can provide exposure without needing to pick every company. Real estate can help if the numbers work because rents and values may adjust with inflation, especially when financed with fixed-rate debt. Treasury bills or high-yield insured accounts can help for short-term cash because they may earn more than large banks paying almost nothing, though they still need to be compared with inflation. Hard assets can help as partial hedges. A business can help if it has pricing power. The mix depends on risk tolerance and time horizon, but the direction is clear. Do not let large amounts of capital sit in the weakest position simply because it is familiar. Familiarity is not safety. Now, what if inflation falls and rates fall? Then the analysis changes again. Your low fixed mortgage may still be valuable, but the opportunity cost changes. If safe yields fall below your mortgage rate, paying down may become more attractive. If asset prices become expensive, capital deployment may become harder. If deflation appears, cash becomes more valuable and debt becomes heavier in real terms. This is why you must keep thinking. A principle-based system adapts. It does not worship one move forever. For now, if the environment points toward debt dilution, inflation tolerance, and repression, then low fixed rate debt deserves respect. If the environment changes, reassess. That is how serious people manage money. Now let us address the claim that doing nothing guarantees loss. In a high inflation or repression environment, doing nothing with excess cash can indeed be costly, but doing something badly can also be costly. So the correct message is not act fast without thinking. The correct message is stop drifting and build a plan. Drift is dangerous because it is not a decision, but it produces outcomes like a decision. Leaving money in a low-yield account is a decision. Accelerating a low-rate mortgage without analysis is a decision. Ignoring inflation is a decision. Not comparing rates is a decision. Not understanding your amortization schedule is a decision. Most people do not experience these as decisions because they are passive, but passive choices still have consequences. That is why awareness matters. When you see the system, you can stop drifting. Now let me frame the whole thing as a balance sheet. On one side, you have assets, cash investments, home equity, real estate. Business interests. On the other side, you have liabilities: mortgage, credit cards, car loans, student loans, business debt. Your goal is not simply to eliminate every liability. Your goal is to structure the balance sheet so that assets grow in real purchasing power and liabilities shrink in real burden, while you maintain liquidity and avoid insolvency. A low fixed rate mortgage can be a liability that shrinks in real terms. High interest credit card debt is a liability that grows against you. Cash earning below inflation is an asset that shrinks in real terms. A productive business or inflation sensitive asset may grow in nominal and real terms. Once you see this, the correct decisions become clearer. Do not attack the liability that is helping you while ignoring the asset that is decaying. Do not preserve the asset that is losing purchasing power while destroying the liability that inflation is eroding. That is the mistake many people make. They pay extra toward a low-rate mortgage while leaving cash in a low-yield account. They feel responsible, but mathematically they may be giving up optionality and accepting real erosion. Again, there are personal exceptions, but the general pattern is worth studying. Now let us bring this back to the grandmother in Toledo described in the source. She has cash in a large bank earning almost nothing. She believes she is safe. She lived through an era where savings accounts, CDs, and paying down debt felt like common sense. She is not foolish. She is applying rules from a different environment. That is the tragedy. The system changes, but many people keep using the old map. An old map can be worse than no map because it creates confidence in the wrong direction. The person holding a low-rate fixed mortgage and productive assets may be positioned better than the person with only cash and no assets, even if the second person feels more conservative. Conservatism must be defined by real-world outcomes, not by tradition. True conservatism is protecting purchasing power, maintaining liquidity, avoiding ruin, and preserving optionality. Sometimes that means using fixed-rate debt wisely. This idea can be uncomfortable, but it is important. Now let us close the loop. The government's debt is enormous. The interest burden is growing. The political system is unlikely to solve it through pure austerity or taxation. The historical playbook is to use inflation and low real rates to reduce the real value of debt. That same mechanism reduces the real value of fixed-rate mortgages. Savers earning below inflation pay the cost. Fixed-rate borrowers may benefit, asset owners may benefit, cash holders may lose. This is the framework, so what should you do? Understand your mortgage. Do not rush to prepay low fixed-rate debt without comparing the real cost and opportunity cost. Check your savings rate against inflation. Do not let large cash balances sit at near zero yields without intention. Maintain liquidity, but make it intelligent. Understand your home equity and do not destroy a valuable mortgage structure casually. If you access equity, do it carefully and productively, not for consumption. Own assets that can preserve purchasing power. Avoid high-interest debt. Avoid variable rate fragility. Think in real terms, measure wealth by what it buys. The system is not waiting for you to understand it. It is already operating every year. Inflation exceeds your cash return. Purchasing power moves away from you. Every year, your fixed mortgage payment stays the same while money loses value. The real burden of that payment falls. Every year, assets with pricing power reprice upward. Owners have a chance to preserve wealth. Every year, savers earning below inflation lose quietly. That is why this is not about politics. It is about position. You can disagree with the system and still position intelligently inside it. You can think the system is unfair and still avoid being on the wrong side of it. You can want better policy and still protect your balance sheet under current policy. That is what adults do in a complex financial world. They do not wait for fairness. They adapt to reality. If you have a low fixed rate mortgage, study it before you pay it down. If you have large cash balances, compare the yield to inflation before you call it safe. If you have home equity, understand it before you access it. If you want to protect wealth, own things that can survive a weaker dollar. If you want peace, build a system, not a slogan, because debt cancellation does not always look like forgiveness. Sometimes it looks like the same monthly payment becoming easier every year because the dollar itself is smaller. And wealth destruction does not always look like a crash. Sometimes it looks like a savings account that still shows the same number while everything you need costs more. That is the quiet math. You can ignore it or you can use it. The difference may determine whether the next decade drains your balance sheet or strengthens it.